So the question for today is if I can still get around 4% on money markets and CDs, why should I take risk in the stock market? It feels like we have been talking about this topic for a couple years now. It first started to gain traction in, I think, around this time in 2023 when T bills first hit 5%.
That was
And
spring of 2023.
yep. Yeah, exactly. So at that point, T bills were 5%. Inflation was running in the mid threes. So, in terms of real yield, so when we say real yield, that's inflation adjusted yields, your yield minus the inflation rate. Real yield was you were getting between 1% and 2% on risk free savings deposits or CDs. So there was a little bit of juice there, if you will. Rates are a little bit lower now. We're still, around 4%, but inflation has also ticked down to high twos. So a little bit of real yield left there. But when someone asks us if or why they should be investing in the stock market when they can get an actual yield on risk-free investments, how does that conversation usually go, guys?
I mean, it usually starts with what you just outlined, pointing out the difference between the nominal yield and what you're actually getting, and just pointing out that there rarely is any, you said juice, but these banks that set these rates on CDs or savings accounts or anything like that, they're not really in the business of giving away free money. So they're kind of keeping a close eye on inflation, keeping an eye on where the Fed sets their rates and adjusting accordingly. We've seen even just at online savings banks over the last year, they've been quick to chop down those rates as soon as rates started getting lowered by the Fed. So it's important to point that out to people. Most people, when they're talking about investments or what they should do with their money, still need that growth component in their investments. So it's rarely going to work out where you can set all of your money in these risk-free assets, getting 4% or 3% nominally. If inflation was zero, then that would be a little bit better, but it's usually never the case.
The exception rather than the rule, this kind of, getting the best of both worlds.
So let's stay with real rates for a minute and understand that real rates of return have averaged somewhere between 1 and 2%, usually 1 to 1.5% historically. So as Casey described, another way to look at this is take the rate of inflation, add another 1.5, maybe 2% on top of it. That's really what you should be expecting on risk-free assets, whether it's T-bills or short-term CDs at the bank. And so if inflation is running at 3%, 4.5 might be a pretty good rate that you can get at the bank or in some type of risk-free assets. But I remember a period of time where you could get 15% on CDs. For me, it wasn't that long ago. It was when I got started in the business. What a lot of people, they talk about those glory days like they're Mickey Mantle hitting home runs. But, you know, it, if you were getting 14 or 15% on a CD, pretty good chance inflation was running at 12.5, 12.75,
Right. Right.
13%, which we did see for a while. Yes, in 1980 and 1981, there was a spike where we did see short-term interest rates, 30-day, 60-day paper, go to 19 and 20%. I was there for that too. So you will see those periods of time, those windows where you'll get more in a real rate of return, but it's usually for 30 days, 60 days, 90 days, a really short term window of opportunity, not
And
something
there's
really
there's
long term.
risk associated with that too, called reinvestment risk. So that is, basically that money's going to come due at a certain point in the future, and then you'll have a decision to make. And rates might be higher, they might be a lot lower. So that decision exposes you to a risk. It exposes you to, forcing you to either continue to roll in a CD or savings account or something like that, or doing something different with that money. And then, you're exposed to the market is doing too. Like you said, Tim, I think it's important to not use what you can get on cash and risk-free investments as a market timing tool. You still want to have some exposure uh, to the stock market in a back portfolio. So just to share some stats and some context for this, I'm going to take some numbers from Ben Carlson, who blogs at A Wealth of Common Sense. Just from a recent post from his, the S&P 500 from 1928 to 2023 averaged 9.8% per year. 3-month inflation adjusted, the S&P averaged 6.7% per year, and T-bills averaged 0.3%, so barely anything for T-bills.
So basically
T-bill
what he's done is he's taken the total rate of return for the S&P 500, reduced it by the amount of inflation over the years to get to that number. Same thing with the treasuries.
Yep, exactly. So he also added that T-bills outperformed the S&P 500 in 31 out of 96 years. So the market was down in those years, and T-bills or cash held up. So it just goes to show that if you just parked our money in T-bills over the long term, inflation is going to eat away at that return, whether it's 3, 4, 12%, like you said before. Inflation is going to eat away at that over time, and you are going to, not have a good hedge against inflation if you put all your money in risk-free assets.
I also think it's important to note that you mentioned market timing. People want to kind of sidestep anything that's volatility in the market. We've had kind of a sloppy market here for the last 6 to 8 weeks. The rates that you're getting on these savings accounts are annualized. So if you're jumping in and out of the market, you want to park some money in cash for 2 months or 6 weeks, getting that 4%, you're getting 2 months worth of that 4%. So like if it's a monthly savings account, every time they pay it, you're not getting paid 4% every single time they pay you. If you hold it for the full 12 months, the annualized term of the rate, then you'll get it. But like you said, about a third of the time you're losing money compared to the stock market, which makes sense if you think about kind of the risk premium that people talk about. So you're taking risk-free assets. So you're taking zero risk. So
No
logically,
reward.
you should get the smallest reward. If you want to earn more, you got to take more risk. Bonds are a little bit more risky than the risk-free assets, and stocks are a little bit more risky than that. So you expect over the long term those assets to outperform. But I think it's important when it comes to market timing to consider, it's not really apples to apples comparing what you could get in the stock market to a couple months worth of interest.
I'll also say, and this ties in nicely with a couple of videos that we've done recently, that the historic long-term return on stocks, like Ben Carlson mentioned, is somewhere between 9 and 10%. And that's the historic long-term rate of return. Now, a couple of thoughts. When interest rates spike, and like they did in 2023, and we saw 5% CDs for the first time, some money came out of the market. That was actually a really good time to be putting money to work. It just seems to me, with my experience, that when alternatives look attractive, it's probably the time that you should be zagging when everyone else is zigging, in the sense that, the spring of 2023, things didn't really look so good. The Fed was looking like they were going to raise rates to infinity, and the market had been sliding for about 9 months. And it really turned out to be a pretty good time to be putting money to work. But that also works in reverse. One of the things that I heard the week of the stock market crash in 1987 was zero coupon bonds for the first time since 1982. Now, 5 years later, in 1987, the yield on zero coupon treasury bonds had broken through 9%. And depending on the individual bond, you were getting close to 10%. And people were saying, hey, I can now get a pretty much risk-free return, almost equivalent to what I could get in the stock market over 20 and 30 years. Why wouldn't I do that? That's actually a pretty compelling argument. So when I hear folks say, I can get 4% or I can get 5%, why take the risk of stocks? I think they're forgetting that the long-term rate of return that we're going to earn in stocks historically has been between 9 and 10%.
Yeah, I mean, we've seen that just recently, like you said, in this April of 2023 was when T-bills first hit 5%. Since that point in time, it's cherry picking the start and finish dates, but the S&P 500's up 35% since then.
Yeah.
So yeah, you could have gotten some nice interest on your cash, but you also missed a pretty nice move in the overall market as well. Just to go back to the reinvestment risk idea and deciding what to do with your money as it comes due. Just a couple years ago, before rates were where they are today, there was this concept of TINA. There, people felt like they had to invest in stocks to get any sort of return on their money. And I think, Tim, do you want to talk about a little bit just about like, do we have to maximize every single dollar of our plan, or right now we don't have to because we're getting a nice little return on our cash here? But talk a little bit about that and how we think about it and coach people up on that.
Yeah, I think when we're thinking about an allocation overall, it's hardly ever, you're doing just one thing with all of your dollars. There's a portion of it that can be allocated for stocks and equity growth over the long term. And then there's a portion of it that, depending on the phase of life that you're in, you want to have some set aside that's not at risk in the market. You talk about risk-free asset like we've been talking about here. That's market risk-free assets. It's not eliminating all risk because you can't do that. So if you're trading market risk for reinvestment risk or other types of risk, just setting your money aside into cash. So I think for people, it depends on when the money needs to be used. It depends on if they're drawing down or if they're accumulating. But for us, it's about right sizing the amount that's in these different buckets, regardless of what you're earning, because even during this, there is no alternative period. It's still worth it to have the proper amount in cash or in these risk-free assets, even if you're earning 0 or 0.3 or 0.5%, because if you need that money liquid, if you need that money to live off of, it's not worth trying to maximize every single dollar in your allocation. You don't have to worry as much about the market risk. You don't have to worry as much about what's
Exactly.
going on a day-to-day basis or year-to-year basis, even if you know you have what you need set aside. So yeah, it's all about trade-offs. You're trading potentially some growth in the account for the peace of mind that, your money is there when you need it, even if it's earning essentially nothing.
Everything has a role. It's just the best of both worlds right now, which is, good for the time being, but anticipate us conversation in the future with some folks. And I feel like we'll be going over a lot of the same points that we talked about here today. So do we want to do our Mets predictions in this one or in a,
Let's do it.
we're already a little late. We're a couple days into the season. That's our 1 and 2. So we do this annually. So we're going to finish at for wins. Last year, I believe, Tom, you said 100. I think I was the closest. I think I said 87. And then Brendan and Tim were both a little low. Brendan, who could not be on the recording today, said 500. So the Mets are going to finish 81 and 81. What do you guys think?
Tim.
I think they're probably going to finish almost identical to last year. So I'm going to say 89 wins. They'll probably get a wild card spot. These 3 games that they've played haven't really changed my opinion long term for the year. So I would have had the same answer had we recorded before the season started. But yeah, I think they'll be pretty good.
I'm still thinking in my head, like, am I going to get booed if I say they're going to win 79 games?
That would be a spicy take. I feel
But
like around the league, there's consensus they'll probably be above 500, close to what they were last year. Maybe even people are expecting them to be better.
I think the Phillies, the Braves, and the Mets have the ability to wind up in a flat-footed tie. If that's the case, then I think all 3 teams will finish with 91 wins, and there'll be some kind of 3-tiered playoff with a coin flip involved.
Like
I
the
don't know.
Texas State Football Championship.
Yeah.
I'm going with 94 wins. I'll be the high
All
watermark
right.
guy. Let's go. Come
I hope
on.
you're right.
I get the division as well. So
All right.
we'll
That'd be
circle
great.
back next year and see how these all turned out.
Okay. Very good. I'm writing it down.